Today I'll be showing you an extremely easy option strategy that you can do for a stock that you think is going to move either up or down. So for this example, I'll be showing you on Twitter because, as we all know, Twitter has been moving like crazy lately because of the Elon Musk purchase and all of that. You can see April 5th here, Twitter's at 52.30. April 12th, a week later, Twitter's at 44.50. So it dropped about $6, $7, $8. So obviously Twitter's moving a lot, and then you can see it bounces back up here, gains another $6, $7, and then now it's flattening out. And then, depending on what news you might hear, you might use this strategy on Twitter. But besides that, we're going to go over here and we're going to click on Trade Twitter Options. And so the first part of this strategy is called a strangle strategy, and you're going to want to do this on a stock that goes either up or down. And so with everything circling Twitter right now, we could be sure that Twitter's probably going to move somewhere but flat. So what we do first is we're going to buy a put. For example, I'll show you we're going to buy a put probably under the share price if you think Twitter's going to go up. And if you think Twitter's going to go down, then you would buy the put above the share price. But we think Twitter's going to go up for this example, so we're going to buy it under the share price. For example, I'll buy it right here, and I'll show you. So we're going to buy a put right there. That's just where we chose. I'll show you different examples in a second, but this will be the first example. And then we're going to buy a call. We're going to buy a call one above the put that we bought. So if you remember, we bought the put right here. So we're going to buy a call one up. So now you should see on this side, this is what it should look like. It should look like a pyramid right here that stops so that your max loss is limited to only $92 and your max profit is unlimited. So for example, if Twitter happens to, and by the way, we chose the expiration date is May 6th. This is 4 days from now. So this is when I really think Twitter is going to move a lot in just a few days. Let's say that Twitter moves from 49.18, which is what it's at right now. Let's say it gains like $2. Let's say it's at like 51.18. Okay, so on the screen we can't see all the way at 51, but at 51.02, let's say Twitter's at 51.02 by May 6th, 4 days from now, then we'll be up $110. And you can see it's a total cost. So we're going to pay to put this into place, and then we start making our money back. So if, let's say, like I said, it's at about $51 and we're making $101, then we'll make our $92 back plus the $101. And then let's say it's at $49.92, just perfectly on the dot at expiration date, then you'll just get your $92 back that you paid. Or even if it sinks a lot and it's at $47.58, you'll get your $92 back again, so that your expected profit, obviously right there, if you can see, it'll say 0. And then let's say Twitter just tanks, falls to like $46.50, you're still up $110. As long as Twitter moves, you make a profit. But I told you I'd show you a little bit of a different setup. So we'll just scoot these down one, and we'll just visualize what that looks like. So we're going to buy a put there at the $48 strike price. We're going to buy a call one above the 48. So we're going to go to 48, one above 48.50, buy our call there. And every time you should get this type of graphic, this little pyramid thing that has a flat top to it, so that your loss is limited. And then you should see a max profit that says unlimited. And then now you see if Twitter goes to 51, now you're up $134. But if Twitter happens to sink and falls right around that 48 price point, then you're now going to lose 124 as opposed to like the 92 from last time. So I think the other setup is better. You gain a little bit less, but you also lose a little bit less. You can also set it up with some gaps in there. It'll just make it to where your max loss is a little bit less, but you're going to need Twitter to move a lot more. But if it does, you make more profit. So you can play around with it, obviously. For this example, I'll show you set up like this. So we bought our put at 48.50, we bought our call at 49. So now we're going to head over here to Option Strat, where we can visualize this a little bit better. So we're going to click on Build, and like I said, this is called a strangle. So you're going to come down here to the middle left, you can click on this one that says Strangle. We're going to type in our stock, we already have Twitter in there, and make sure you choose the proper expiration date that you chose on your trading platform. So since we chose May 6th, we're going to mirror that over here, May 6th. And now we just copy this. So if you come over here and you see this you see long strangle, there you go. As long as it says long strangle, you did this properly. And if you saw that visual, then obviously you did it properly. But we're going to copy this little setup here. We're going to put it into Option Strat. So bought a call at $49. So C for call, we bought it at 49. and then we bought a put at 48.50. So P for put, 48.50. There we go. So now we can see, let's move this chart range a little bit so we can see where Twitter's going to have to be on what day. And what I like about option strat is it shows you day-by-day results and the time of the day results to see how much money you'll be earning. So let's say on May 4th, Wednesday, at around 10:45 a.m., let's just say that Twitter goes crazy and rallies up a lot, and it's sitting around 50.90. You'll be up $99. And then if you wanted to, you could close out and then just take your profit there so that you don't risk Twitter falling back down towards the middle. But like I said, all you want is for Twitter to move up or down. And with any stock that has a lot of controversy around it right now that you think is going to move a lot, you might want to try this out on that. And you can obviously move around the implied volatility and see how that'll affect things. But for now, we'll reset it to what it's at right now. But yeah, like I said, you can range this out to see what it has to sit on what days. Obviously, I recommend you try this out with other stocks, not just Twitter, and see how it sets up. And obviously, I would always use option strat before you put the option into place, just to see what it will look like a little more visually. But yeah, that's how to do a long strangle with Twitter. And yeah, if you have any other questions, comment them down below, and I'll be sure to answer them. And thank you for watching.